And now for our segment, 5 minutes on the market. 2023 was a strong year for markets. S&P up 22, the Dow up 13, emerging markets up 4, and bonds up 2.3. January has started sideways. S&P up 2.5, the Dow up 1.2, emerging markets down 3, and bonds down 1%. What's our outlook for the new year? What's our outlook for 2024? Is it going to be another strong year? Well, 85% of the technical indicators that we track are currently positive. It's a good sign. Also compelling is when the Federal Reserve cuts interest rates. Historically, when there isn't a recession and they're cutting rates, it's usually a really good sign. Now, recently, 08 and 01, we saw the Fed cutting interest rates going into recessions. Those were difficult times for the market. But this is a little bit different. If the Fed is cutting and we're not going into recession, it's usually a positive. The market in 2024, we believe, is going to be driven by forces similar to what we saw in the 1970s. When inflation was going higher, the market was going lower. And when inflation was going lower, the market went higher. Expect more of that in 2024. Inflation heating up would be a big negative, but we're not seeing that now. We like the slow, steady move higher that we saw in markets last year. Since 1950, when it took the market over 12 months to reach a new all-time high, when it did reach that new all-time high, the market was positive a year later, 13 of those 14 times, on average 15%. Also, following a year when the market is up 20%, since 1950, the following year, the market was positive 80% of the time. And although usually not higher than it was the year prior, still higher than it was at the beginning of the year. From a technical standpoint, at the end of the year, we saw 90% of S&P 500 stocks above their 50-day moving average. Since 2000, stocks were then higher a year later, 98% of the time. Is it a sure thing? No. But a good sign? Absolutely. Next, let's take a look at where the top 20 firms on Wall Street think this market is headed for 2024. The biggest bull thinks the market's up 14%. The median think the market will be up 3%. The biggest bear thinks the markets will be down 12%. Is that normal? In short, no. A bottom-up 12-month price target historically has averaged 17%. Now it's only 11%. In short, forecasters think returns will not be as good this year as they were last year. Now, this is an election year. Is that good or is that bad? The year before a presidential election cycle are some of the best years to be invested. Politicians will pull whatever levers they can to get reelected, and that often pushes markets higher. Keep in mind that Q1 of the presidential election cycle is often the weakest, and we tend to believe most of the gains this year likely happen in the second half of the year. What's our commentary on the market? We think the S&P is up 7 to 11% this year. Normal volatility, 10 to 15% decline along the way would be expected. We think it's a great environment for buffered ETFs. If you don't know about them, you need to. These buffered ETFs have maturity typically less than a year. They're liquid, so you can get in and out of them anytime you want. They typically offer buffers of protection between 10 and 15%, and the upside will be capped at between 13 and 20%. Very interesting in a world where analysts think the market could be up as much as 14%, but could be down 12%. In fact, we prefer them to traditional equities in this environment. We think small caps provide interesting opportunities, and we've got some exposure to small cap buffer ETFs as well as small cap equities. We're adding some additional conventional equity, and actively managed equity strategies are becoming more relevant again. Our average cap on the upside buffered strategies that we're utilizing is about 16%. Our average buffer of protection on the downside right now currently is 12%. And we're preferring S&P buffers over NASDAQ. Our average moderate allocation for IRAs has about 80% in buffered equity exposure at this time. Now, for more conservative clients, there's definitely some strong yielding opportunities out there. You want to be a little careful of bonds as the Fed is forecasting 3 rate cuts, but the market's expecting 6. Sounds like there could be a disconnect there, could be a little bit bumpy. We're positive about the market going into 2024, but a friendly reminder that some level of volatility is normal. Since 1928, a 3% decline happens 7 times per year. A 5% decline happens 3.5 times per year. And a 10% decline on average happens every single year at least one time. We don't think this year is going to be any different. We think the market will be higher by the end of the year, 7 to 11%. And we think we have the right equity strategy to take advantage of opportunities in this market. Hope you enjoyed our 5 minutes on the market.